Well, overnight oil futures dropped 2%, falling below $70 a barrel off the back of concerns about global economic growth and revived risk aversion. On the flip side, gold has rallied as investors put their cash in traditional safe havens. For more on the volatility on commodity markets, I'm joined by Jonathan Barratt from Commodity Broking Services. Jonathan Barratt, welcome to Business Today.
Good morning, Whitney.
So, it's been a very bumpy ride for commodities. Has this surprised you at all?
Whitney, no, it hasn't. I think people are weighing so much on the expectations of concerns in Europe that a lot of our commodity markets have come under a lot of pressure. A lot of pressure, and basically it come no surprise. But I think there is a silver lining to it, because I actually start to think that we still have very solid growth in Asia, very expected good growth in America, and I think that commodities in themselves are looking relatively cheap.
But it's interesting, though, the markets don't seem to be looking at those growth signs. They seem to be more concerned with what's happening in the Eurozone and Korea. Yeah,
that's the markets tend to get ahead of themselves quite a bit. And I think that, to me, is always a concern. But with that, it provides us with opportunity. We have seen a lot of negative rhetoric out there. But when you look at it, cheaper commodities make economics work. And if you see your primary imports at relatively low areas, then that only encourages economics. And I feel that the market in itself could actually get ahead of itself. And I think that's what occurred at this stage, because 3 months down the track, when we do see this blow over or this contagion fully understood, then we'll all of a sudden see demand pick up, and we could in fact have a little bit of a hole for commodities, and that'll be a concern because prices then will rally quite quickly.
All right, well, that's interesting because overnight, as mentioned, oil fell below $70 a barrel. That's a long way from those heady days of $146.
It is. I mean, it really is. I mean, when you look at it, all this is on expectations in supply and economic growth. The price action for oil, particularly last night, was interesting because it traded to as low around about that 67, 70, 68. But then we saw a very, very strong rally back through just under $70 a barrel. Now, there's signs that people feel that the prices have actually gone too far. And in fact, that analysing growth forecasts going forward, that oil at $70 does represent perhaps a very cheap commodity. 146 down to 67, I think it's about time we had a bit of a correction. It's nearly over 50%. So from that, I'd like to think that we can be long crude.
Well, Gulf oil ministers have also hosed down the drop, saying that OPEC has no plans to call an emergency meeting. But surely they must be concerned on some level.
Yeah, they are. I think they will be. But you tend to get a little bit of murmurs coming through what they're actually thinking. I think if we get a sustained price action below $70 a barrel, then you'll see a little bit more persuasion coming back into the market. There is a little bit of while between or for the next OPEC meeting, but I would actually feel if we do get sustained price pressure below $70 a barrel, then we'll see the ministers starting to come out and saying, well, look, let's look at some form of production cuts. But at the moment, OPEC are producing to capacity and overcapacity.
All right, Jonathan Barratt, let's move on to gold. All this bad news for oil has actually been good news for gold. The uncertainty has pushed it higher.
Gold's been quite interesting because it's sort of in risk aversion that came under pressure down to 1170, and then she's rallied back up to 1200. I think it's a lot to do with what's happened with concern, particularly out of Asia. When we do get that political unrest, people do go to gold. And we've also seen the US dollar come under quite a lot of pressure just over the last 24 hours. So when you combine the two, that gives us a good story, a good feel-good story for gold, and that's why we're seeing gold trade back through 1200.
And interestingly enough, we've seen China being one of the biggest buyers of gold recently.
China will continue, I think, to remain on the bid for gold, whether it's from its domestic mines or whether it's internationally or wherever they can get it from, because they have to have that reweighting within their basket for gold, because I think, as we all know, gold represents that stability for the country. So I think they'll continue to buy.
Just briefly, we're nearly out of time, but do you think that that signifies that they're moving away from US Treasuries then?
Yes, I think it is.
All right. Concise as always. Thank you, Jonathan Barratt.
Thanks, Whitney.